Today we are presenting on running a business in an entity structure and what kind of entities may be suitable for you. Hopefully now, after some good news from the government the last couple of days, people are now looking at business and opening, and we can start reviewing what's best for everyone. So before we start, just a couple of housekeeping rules. Please ensure that you keep yourself on mute while we are presenting. We will also be recording today's session and also it will be put on YouTube, but we can send you a copy. So please just put in the chat to Laken and Laken can organise that for you. Any questions? Laken is our chat box moderator today. So any questions, please pop it in there and she will announce the questions at the end and also a poll. So for those of you that are joining us for the first time, Rubik's is a boutique accounting firm and we base ourselves on the Rubik's Care Factor. The 5 promises down that you see down the bottom are what we base all our advice and work on, and it's our day-to-day mission and what we stand by. So in our topics today, we're going to cover the different structure types, the tax advantages, the asset protection, CGT, how super can play a part, and then we'll finish with questions and a quick little optional poll for you to complete so we can make our webinars just that little bit better for you. So today I would like to introduce our speakers. The first one is Mark Debblejack. Mark is the founding director and co-owner of Rubik's and has 30 years experience in the accounting industry. He's also a fellow of the Chartered Accountants Australia and New Zealand, and he has extensive knowledge of all things accounting, tax and superannuation. Outside his working life, Mark enjoys spending his winters on the ski slopes, not this year unfortunately, and traveling the world experiencing food and culture, which hopefully might happen in the next 12 months. Our next presenter will be Stuart Coulthard. Stuart is a partner and co-owner at Rubik's with over 20 years experience. I should also say that we are celebrating 10 years of being Rubik's this year, so it's very exciting. Stuart's passion is tax, asset protection and business advisory and a focus on the Rubik's Care Factor. He was nominated in 2019 for Partner of the Year for a boutique accounting firm. He's also a keen Essendon supporter, just like me, and a keen runner and sourdough baker. Our newest presenter of our webinar series today is Ashley Bravington. Ash is a supervisor at Rubik's and also probably our super guru. He's been with Rubik's for 5 years and he's also a member of the Chartered Accountants Australia and New Zealand. Outside of the accounting world, Ash is a firefighter for Carrum Downs and was very brave and fought in the bushfire fires earlier this year. He's also now become a Brisbane Lions supporter thanks to Mark's influence, but secretly has a desire for Fremantle. Last but not least is myself. For those of you that don't know me, my name is Eliza Smith and I'm a client manager. I come with over 13 years accounting experience and my passion is in advisory and compliance. I am a keen Essendon supporter, just like Stuart. I love my food and wine. I guess with the wine, there might be a connection with being an Essendon supporter, but I love all things seeing my clients grow and succeed. So moving on for today, I would like to introduce Mark, who will kick us off with different types of structures.
Good morning, ladies and gentlemen. Thank you for joining us today. Why are structures important? Eliza, we need the slides. Okay. Possible? Thank you. Structures are important because that's how we deal with the rest of the world. That's what the world sees of your business, and they have implications, many implications. Some of the ones we're going to talk today about are legal implications, there's tax implications, and there's personal liability implications as well. Structures are the key to basically a good, sound business. The first one I'd like to talk about is the simplest one, which is a sole trader. So this is simply a person doing business in their own name. It's the quickest one to set up because there is no setup. You basically open the shingle and you're in business. You do require an Australian business number, so you have to register to be a sole trader. And when your turnover reaches 75,000, you've got obligations in relation to GST and you have to register. We recommend you operate in a separate bank account as well. So separating your business transactions from your personal. As I said, this is the simplest way to set up business and the quickest. And often when people start micro businesses, they'll use this structure because it's simple. We'll have some comments later about whether it's an effective structure or not. The second structure that is fairly common is a partnership. Now, a partnership can be between two individuals. They can be between, say, a husband and wife for a business partnership, between a husband and wife, or they could be through two friends. And later on, we'll talk about some tricks to partnerships that can be actually really beneficial. The difference between a partnership and an individual is you actually need a separate tax file number to operate a business partnership, as well as an ABN. Once again, once your turnover reaches 75,000, you're expected to register for GST. And we highly recommend in this structure that you operate in a separate bank account. Interestingly enough, with partnerships, they could be a verbal partnership or a written partnership. So I think we recommend people write a written partnership, and that's mainly because it gives some rules around the partnership. Now comes probably the most common structure that people use in Australia, and that is operating their business through a company. A company requires registration with ASIC. It has directors who run the company, and it has shareholders that own the company. So there's a separation between the management and the ownership. Sometimes the directors are not the shareholders, and it offers a whole stack of flexibility in relation to ownership and control. Companies operate under a constitution, and that basically gives the rules of how to operate. They are also a separate legal person, and that becomes more important later when we talk about liability. So this is the most common structure in Australia. It's not necessarily the best, but it's one that most of our clients have some experience with. Let's move on now to trusts. These are an entity that's formed by a deed, and the deed gives the rules. It requires a trustee, a beneficiary, and beneficiaries as well. Now, the trustees can be an individual or they can be a company. And that we'll talk about a bit later with liability as well. There are a couple of different types of trusts. Today, we'll talk about fixed trusts and discretionary trusts. Fixed trusts are trusts that have a fixed entitlement, and they may be used, for example, by two families doing business together. So they might have 50% of their units together. Whereas a discretionary trust is probably the more common one we see nowadays. And this is where one family may own a business or an asset, and it's held by this family trust. And there is discretion on how the beneficiaries receive their income. So this is very effective when we start talking about the tax issues around structures. Now, like any of these, there is also a variation of all of the above. So we kind of call this a hybrid of entities. And I've just put up one example today of a hybrid of entities. We have two families here who want to do business together, but they both want to share the benefits of having a family trust to use discretion or flexibility on the distribution of both income and capital gains. So we've put together this structure for them where we operate a partnership, and that partnership doesn't need to be a 50-50. We've got examples in our client base where it's 25-75 or 95-5 even. And in this scenario, we've put a corporate manager in as the trustee. That means that the outside world believes it's dealing with a company, but in reality, it's dealing with a partnership of two family trusts. And we've popped the corporate trustees in there to give separation and some asset protection, which I'll go through in a few more minutes. So, like any of these structures, this is only one example of a hybrid structure. Any of the structures above, we can hybrid those structures to suit circumstances. So I think I'll hand on to Eliza now, who'll talk about tax.
Thank you, Mark. So as Mark mentioned earlier, with any of these structures, there is also one of the main factors to consider is the income tax implications. So today I'm going to go through with you the main structures as Mark commented on and the tax implications for each of them. So as we said, the easiest structure to start with is a sole trader. Any business profit that the sole trader makes is taxed at their marginal tax rate. And as you can see on the right of the screen, I have put the marginal tax rates there. They have been updated for the new tax changes as well, so the new rates are included. The profit of the business is added to any other income of the individual. So whether there's rental properties, a normal salary and wage, or interest and dividends, the profit is then added to that other income, and that total income is taxed at a whole. If you do experience a loss in your business income in your own name, there is certain circumstances where that loss can be offset to reduce any of that other income. However, there is 4 tests that need to be passed. And if this does apply to you, we will run this through with every individual situation, because today it's probably we don't have enough time to go through each one. If you do run a business through your own name, you are entitled to receive a $1,000 up to $1,000 offset to reduce any income tax payable. And this is known as the small business tax offset. So with the partnership is all dependent on who the partners are. So in Mark's example before, we had 2 trusts. So if we had 2 trusts, then the trusts would be considered, that income from that partnership would go into the trust and then to the beneficiaries. So the level of tax will be dependent on what structure the partners are. So going back to the sole trader, if you had, say, for example, myself and Stuart were partners in a business partnership, any profit that would make would then go into Stuart and I's personal name and be taxed accordingly. If we're 2 companies, then the companies would be taxed on that partnership distribution. The partnership has to lodge its own tax return to show that flow of distribution and to make sure that any losses are applied. If the partners are an individual or a trust, then they will be entitled to that $1,000 small business offset. However, to a company, they are not eligible. The treatment of losses, so each partner will receive the losses if there is one. However, that treatment will depend on, again, which partner they are. So if it's carried forward or used to offset any other income. So the company business structure, again, is the most popular. It's probably the most easiest to follow if you are earning probably over at least 80,000 and your marginal tax rate is above the company tax rate. So for the 2021 year, if your turnover is under 50 million, so that is turnover, not net profit, so the sales that you make, you'll be taxed at 26%. Anything above 50 million, you will be taxed at 30%. Every dollar of income or profit that you make will be taxed. There's no tax-free threshold. So if you make $1 of profit, then you will be taxed at 26% and pay 26 cents tax. If your company is a mixture of a business and investment, then we have to apply a test which is known as the base rate entity test. And this is based on determining if your income is purely business or investment. If your net profit is more than 80% investment income, your whole profit will be taxed at 30%, not the reduced rate of 26%. As we all know, dividends come from companies, and the franking credits that are attached to those dividends are applied to at the tax rate that the company received last year. So this is a year by year basis. 1 year it could be 30, 1 year it could be 26. So this could change on the situation and what you use your company for, but the franking credits that are attached to any dividend will depend on the company's tax rate. So trust and unit trusts. Like a partnership, the trust 90% of the time will not pay tax in its own name. However, if there is no beneficiaries to the trust that are presently entitled, any income will be taxed at 45%. Here at Rubik's, we'll make sure that we review your trust deed yearly, prepare your distribution minutes before 30 June, and ensure that there is beneficiaries that will receive income, so you can reduce your tax and not be paying at 45%. Whoever the beneficiary is the rate of tax that will be paid. So say, for example, again, if it's an individual, then it'll be at the marginal tax rates. So if it's under 18,000 and they have no other income, then no tax will be paid on that distribution. However, if you do distribute to a company and the company is just to receive distributions, that distribution will be taxed at 30% less any other offsets or franking credits. So this is why that we take tax planning and trust distribution so important before year end, so that we can plan to ensure that any tax is minimized and no surprises when we lodge your tax return. If the business is trading under the trust and you distribute to an individual, then again, you will receive the small business offset of up to $1,000. If you are distributing to a non-resident, and some trustees do allow this, then that non-resident will be taxed at non-resident rates. The only income that the non-resident will not be taxed on will be franked dividends, interest and royalties, because the trust will withhold any other tax from that. So from one income tax implication to asset protection, I'll move back to Mark.
Thank you, Eliza. As you can see, depending on the structure you have, taxes are very different. So why is asset protection important? Well, can we move to the next slide? Thanks. Because when you're in business, you need to think about the risks. You have liabilities to customers. It could be for a product you produced, or it could be a service that you delivered. There may be a fault and the liability could come back to the business. If you have staff, you always have liability as well. If a staff member injures themselves on your work premises, then potentially you could be personally liable for that liability. Also, things out of your control. There could have been a sexual harassment claim in your business that you weren't aware of, but because it's your business, you would be liable. And of course, there's the creditors and banks as well, who you could be liable for depending on your structure. So let's talk about how asset protection is in the different structures. The sole trader, while it's very simple to set up, a sole trader is personally liable for all debts of the business. So that includes customers, employees, banks, creditors. There is no protection of personal assets in this structure. So if you happen to have a home, your creditors could have access to your home. So obviously this is not a great structure to have if you have business risk or any risk at all that I mentioned. Now, partnerships are also, the partners are personally liable for all the debts of a partnership. Interestingly enough, partners are joint and severally liable for all the partnership debts. What that means is you might be in a 50-50 partnership, but because you're a partner, you are responsible for 100% of the debt. So if your partner can't pay their share of the debt, then you as the other partner are liable for all the debts. And if you're an individual, again, your personal assets are up for creditors and are liable as well. So this is not a great outcome if you're simply dealing with individuals in a partnership. Let's talk about companies. Now, as I said earlier, companies are a separate legal entity. So what that means is that the company itself is liable for the debts. And interesting enough, the limited part, where you see proprietary limited, the limited part means that the members have limited liability. They only have liability for the shares that they bought in the company. They don't have any further liability. So often you might see directors and shareholders are different people, and that's because of where liability lies. There are some liabilities that directors are liable for. There are some, if you have some unpaid taxes such as GST or employee PAYG, directors in some circumstances can be personally liable for that. Also, if you trade while you're insolvent, those laws don't apply in this current COVID era, but in normal circumstances when they are put back in, if you trade while insolvent, the debts you accumulate while you're insolvent can be personally liable. So whilst it's not a perfect structure, with some good control over your business and good advice, making sure your taxes are paid up, and if the business is in trouble, that you do take action pretty quickly, you can actually limit your liability very effectively and not expose your personal assets. So this is a very strong entity for asset protection. Let's have a look at trusts now. The trustee of a trust is responsible for all of its debts. So earlier when I spoke about the fact that trustees can be individuals or companies, obviously an individual trustee would be responsible for all debts. So that's not a great outcome, but if we use a corporate trustee, which is very, very common, we then reduce the liability to basically the liabilities around tax and insolvency. So this is a very good way to limit your exposure to risk. Now let's look at how we can combine some structures to separate risk as well. So at Rubix, we're a firm believer that you should separate your risky assets from your investment assets. So if you run a business and you own the premises, you wouldn't want those premises in the same company that you run your business. So we'd recommend setting up a separate entity for that. And depending on the size of each transaction, you may even want to use single purpose entities. Some of our most successful clients have strings of entities. So they might have 5 or 10 entities because each one's set up to do a particular transaction. I'm not recommending that in all instances, but definitely separating assets from risk, having a separate trust with a corporate trustee to own assets is very, very effective. So in summary, I think having a corporation involved in your structure, whether it's running through a business or as trustee, offers you the maximum protection for your other assets. So we might move on now, and I think we have Stuart talking about GST.
GST, no, I might cover CGT.
CGT, sorry.
GST is a whole nother story. But what I am covering off on here today is the impact on capital gains can have when operating in different types of entities. So next slide, please, Eliza. So depending on the entities that you're actually operating your either business or investment out of will impact the CGT and the way it's actually calculated. A lot of our clients go into getting an entity before, always thinking about tax, trying to save tax now. Then they start thinking about asset protection. So again, it's very now focused, where capital gains can arise later on in the future. So what if you set up an entity now, but then when it comes to actually selling your business, what is the CGT impact on that sale? So CGT does need to come into your thinking when you're setting up either a business or an investment. What I wanted to touch on as well is if you do sell your business, and there is either trading stock or depreciable items or debtors and intellectual property, the tax outcomes are very similar depending on all the entity structures they actually have. So that doesn't really come into it, but the CGT is different. Next slide, please, Eliza. What the first, we've covered off on sole traders a fair amount today, but if you purchase a business or run a business out of a sole trader, and then you go and sell that business, what that actually enables you to do is, first of all, get access to the small business CGT concessions, which we've covered off in previous webinar series. So there's a fair amount of information around that and fair amount of rules. But the fact that you are a sole trader gives you the eligibility to go into or go into and actually get the small business CGT concessions. Also, what you're eligible for is the 50% CGT discount. So that's on top of the business concessions. So that's a good thing. But if there is capital gains either from a business sale or an investment sale as well, the capital gains will have to be included into your personal income tax returns. You can't actually split that capital gains between anyone else. It's got to go into your personal ones. And that capital gains will be subject to the marginal tax rates that we covered off earlier as well. So again, as I said, if you're selling an investment, there is a 50% discount too. So regardless if you're selling a business or an investment, you can get access to that 50% general discount as long as you've owned that business or investment for more than 12 months. That's a key requirement. Partnerships, very similar to sole traders. You can get access to the small CGT, the small business CGT concessions, which again can reduce, or in our experience with some of our clients, can reduce capital gains on the sale of a business down to zero. So that's one good thing. Eligibility for, again, can be eligible for the 50% general discount. Again, that's on top of the CGT concessions, but it really depends on the partners involved. That's also in regards to the small business CGT concessions. It depends on them, as opposed to sole trader, we're really only focused on one person. With the partnership, you've got to bring into the two partners or three partners, depending on how many partners are involved. When the capital gain is actually established around either a business sale or a business or investment sale, the capital gain will be calculated depending on if it's a partner, an individual. So they'll be paid tax on the marginal tax rates, which Eliza covered off on, all depending on who are the actual partners, the more elaborate, complex structures that Mark talked about. But as I touched on, or Mark touched on as well, you need to have a partnership agreement. We recommend all our people who go into a partnership to actually have a partnership agreement, because that'll determine the split of any profit as well as any capital gain. Without that, it just opens you up too much. Next slide. As we've mentioned a number of times during this webinar, companies are the favourite or the most popular. And one of the reasons they are popular is because they're really simple to understand. You know exactly what you're getting into. But with a company, you can still get access to the small business tax concessions depending on what's the eligibility for it. But the one major difference with a company is you can't get access to the eligible 50% discount. So that, first of all, you're missing out on 50% when calculating the capital gain. So when thinking about setting up a business structure, really think long and hard to see if you really want that 50% discount. It's people set up companies for different reasons, and not all they often really suit the circumstances they're going into, but they're losing the 50% general discount when they set that up. But that's if a company is actually selling the business as opposed to selling the shares in the company, you can get actually eligible. You can become eligible for the 50% CGT discount. So depending on what you're selling, depending if you're selling the business or selling the shares in the company. If you're selling the company, we've got 27.5% there. The rules have changed to 26. So rely on Eliza's information rather than my information. That'd be great. But how you calculate the actual tax figure that a company pays tax on when you work out all the capital gain, it's going to be the company tax rate from $1. So where individuals have a marginal tax rate, where the more you earn, the more you pay, a company pays tax at the $1. So there's no tax-free threshold for a company. What we find with when a business is being sold out of a company is you've got to actively manage how you get the cash out, because as Mark's touched on, it is a separate legal entity. So if a business is sold within a company, getting the money out, it's the company's money. So you've got to work on how to get that out tax effectively, because there can be a taxing point there. What we find in the past as well is that we liquidate that company. That can also provide tax benefits too. So that's something to think about too. Next slide, please, Eliza. And one that a lot of our clients have are trusts. When trusts either sell a business asset or business, as well as an investment within a trust, we can actually still gain access to the small business CGT concessions. So that's a big tick for that environment as well. Also, in contrast to the company, there is that 50% discount that a trust can be eligible for, as long as they've owned that investment or business for more than 12 months. Who actually pays the tax? Trusts don't actually pay tax. It's the beneficiaries who actually pay the tax. It's the unit holders who actually have the taxing point. So the capital gain is actually pushed down to whoever the beneficiaries are. So knowing who the beneficiaries are is all determined on the trust deed. Knowing who that is, and also knowing that you've got a signed distribution minute, as Eliza touched on earlier, that will determine who pays the actual tax on any sort of capital gains. So if a trust distributes to a company, the company will pay 26% on the actual capital gain, but the company won't actually get the 50% discount, the CGT discount that I've touched on earlier. So distributing to the right person, if you can, will depend on what marginal tax rate you pay. What we find as well is if a trust is a unit trust, getting the cash out as well can be sometimes a little bit difficult, because if there is tax-free portions within a business sale or an investment sale, it becomes a little bit complex when the unit trust is involved. So that needs to be considered as well. So I guess there is a lot to think about when you're setting up either a business structure or an investment structure, and picking that right can be really important. That's why people come to us, because we're experts at this sort of stuff. But what we're sort of touching on now is that I'm going to hand over to Ash, who's going to be covering off on how super can play a part in your business structure. Over to you, Ash.
Thank you, Stu. So superannuation as a whole won't form necessarily a large part of your business, but it might, as your business grows and develops, it might become part of your retirement plan out of the business. Thanks, Eliza. So first off, I'd like to touch on the fact that in theory, a business can be run outside or through a self-managed super fund. However, this needs to be specifically permitted by the trustee, and it needs to fall within the SMSF rules of what's called the sole purpose test. So this is where everything done by the SMSF must be done for the benefit of its members upon retirement. So this means that an SMSF cannot have credit arrangements, they cannot have an overdraft, all stock needs to be paid for in advance or cash on delivery. The ATO also tends to look very closely at SMS-run business to ensure that the SMSF is not indirectly supporting members by paying them wages before they retire. There are very difficult rules there. So the reason it's mainly mentioned is it's sort of like a Jurassic Park example. Just because it can be done doesn't mean it should be done. Thanks, Eliza. However, one way it can help is by supporting the business. So in the example shown here is owning the business premises your business runs off. So rather than hold a $300,000 property within your business and lock up all that capital there, is to offload that property to your SMSF, and then that way you can pay rent to the SMSF. So you are then receiving the business deduction for the rent, and the money you're paying is actually contributing towards your own retirement. So as the example shows there, that if your business is turning over $250,000 a year, you'd be paying $65,000 in tax. But if you're paying rent to your self-managed super fund, the business would pay a reduced level of tax. The SMSF would, of course, have to pay its own balance of tax, $10,500, but overall you're still saving nearly $8,000. And this, of course, then the balance of the rent would be increasing your own super balance for your eventual retirement. Thanks, Eliza. So this allows you to circumvent the normal $25,000 contribution limit, which is in place for everyone across the board in Australia. Property can stay within your SMSF even if your business moves or is sold. So you can sell the business and keep the property and continue to rent it to the new owners. Alternatively, if you've already retired, you can sell the property to someone else. And if all members are in retirement phase, the sale is completely exempt from CGT. Now, if the members of the SMSF are still working, then you are entitled to a 33% CGT discount, which applies to all SMSF capital gains events. Then the balance of that, obviously, you're only paying 15% tax on at the super rates. So the other considerations that need to be taken in when looking at an SMSF to decide if it's right for you are the arm's length treatment of a relationship. So this means where a company you can sit there with, you have a very close relationship. An SMSF must be treated as a stranger. So market rates are required for rent, and you should consider legal advice around lease agreements. Everything needs to be done for the ATO and the auditors to see, okay, this is being treated as though you're out in the market and you're getting the best result for your members. You might also need to consider limited recourse borrowing arrangements to purchase the property in the first place due to the rules around SMSFs having credits. So the other costs to consider would be your annual compliance costs. So there's an ATO supervisory levy, there's the audit of your annual accounts and your tax return lodgements. So the audit requires substantiation of all SMS transactions, mainly so the ATO has an idea and comfort that from a third party that your self-managed super is not being used as a business or personal slush fund. As a whole, the government takes a very dim view of super being used for anything other than its intended purpose, and the penalties can range from a few $1,000s to $13,000 or more dollars. On top of that, your super fund may be deemed non-compliant, which means everything will be taxed at a 45% tax rate. So overall, an SMSF can be used as a retirement vehicle, and as long as it's used correctly, it can be a useful support entity to your fund. I'd like to pass back over to Stuart.
That's okay. I'm going to jump in for Stu. I think he's done enough talking for today. Just to let everyone know, that's the end of our formal presentation. We do have another webinar coming up in the middle of next month, which is going to be around insolvency. Obviously, we're going to have quite a few companies that are struggling after the whole COVID situation. So we are looking to provide some information to our clients as well as anyone that our clients may potentially be dealing with. We're going to open up the floor now for some questions. Our contact details are up on the screen. If you do have any questions, please pop them into the chat, address them to me so that I can ask them and the guys have got the ability to answer. And then at the end of question time, we're going to open up the poll, which is optional. To answer the poll, all you need to do, it'll pop up on your screen, tick the boxes that are relevant for you and press the submit button. You can, of course, leave without answering the poll. That's completely fine. We would just like to get as much feedback from everyone as we can. So if anyone has any questions, just pop them into the chat. I don't have any at the moment, so I'll just give it a minute or two and then I'll open up the poll if we don't have any further questions. Okay, so we do have a question around unit trusts. Are you seeing many unit trusts, and if so, in what industries?
I'd have to say we don't seem to see a lot of unit trusts. They tend to be older, pre-existing structures. In the past, we used to see it before we did the hybrid partnership of trusts. and it's mainly because of the issues around getting tax-free income out of unit trusts. It's very difficult to get tax-free income out of unit trusts. It's not a structure we would discount, but it's not a common one. And where we do see it, it's generally people in business. Rather than using a company, they're using a unit trust.
Probably the most environment that I see it in is around property development. People buy units in a unit trust that does the development, and that's probably the most recent sort of structures that I've seen in the last couple of years around unit trusts.
And the big difference there with property development is that that income is almost always taxed as income as opposed to capital gains. So there's very rarely that would a tax-free income flow through a property development.
Cool. We have a question. Is it difficult to change structures after business has commenced?
It's not difficult. There are concessions now available to change or transfer businesses from one entity to another. There's obviously a lot of rules to be ticked to be able to do it. So previously you weren't able to roll a business into a trust. You can sort of do that now as long as you meet a lot of requirements. We find there's a lot of admin headache to make these changes, but if the circumstances suit, yes, you can do it. It's also depending on what you are rolling out. For example, if you owned an investment property or the commercial building in an entity, we wouldn't advise to roll that out of the particular structure because stamp duty would be involved. So it can be done, but depends on the circumstances and depends on the requirements for it and meeting all the requirements that are put in place by the ATO.
Do sole traders benefit from depreciation and instant asset write-off?
Yes, they do. So that it's no different to where those rules apply to companies and trusts and partnerships. So all those small business tax concessions apply to sole traders.
So as long as you've got an ABN and you're running a business is the two.
Okay. Are there any retrospective tax advantages to changing structures?
Retrospective. I guess retrospective, I mean, you're saying if you roll tomorrow, can you go back and amend a tax return? Is that the question? I would say no. So what's happened in the past stays, I guess, in the history of that particular entity structure. So yeah, I think I've answered your question there.
With asset protection provided in company structure also comes numerous requests for personal guarantees. In the instance that a company creditor calls a personal guarantee, are there any tax deductions allowed to the individual who ultimately pays the guarantee amount?
It depends on the circumstance on how the debt was created. So, for example, if you guaranteed a bank loan and ultimately you had to pay out on that bank loan, in certain circumstances, you might end up with a capital loss. Capital loss is probably the least best outcome because you can't use it against income today. And then it just really depends on the circumstance and the structure you're talking about in relation to the guarantee.
Great. Well, I might quickly pop the poll up for those people who want to answer. You can still keep sending questions through if you like. As I said, please remember to press the submit button once you have answered the poll. And if anyone has any further questions, they are free to contact any of our presenters whose contact details are on the screen. Otherwise, feel free to send them through to our reception address of reception@rubix.com.au.
once everyone finishes, the poll will let you out. Yeah, is that right?
They can leave as soon as they're finished if they like. We're not going to hold them here.
We encourage you to finish the poll, though. We encourage it.